Thank you for joining us again. In this session, we will discuss how to address financial and operational risks. We will look at financial and operational risks from two lenses. First, we will discuss how financial and operational risks should be accounted for in the design of a project in order to implement risk mitigation measures early on and improve the chances of success of a project. Estimating, addressing, and mitigating risks is a requirement of many financiers to even consider investment projects for this very good reason. Secondly, we will look into financial instruments that serve to reduce or cover for risks and thus allow for the implementation of climate action for investments. So let's start. Let's define risk. What is a project risk? A project risk is an uncertain event that may or may not occur during a project and that may affect the intended project outcome. While the word risk has a negative connotation, a project risk materializing could also have positive effects at the project outcome. Either way, it serves us well to try and account for project risks in the project design, estimate their likelihood and impact, and include risk mitigators. At this stage, it is important to state that project risks and barriers are not the same. Barriers are what keeps us tethered to the status quo, what keeps the needed investments into a low carbon and climate resilient economy from happening. We conduct the project, the intervention to overcome the barrier. If the project is fulfilling its intended output, the barrier is overcome, at least in the limited context of the project's remit. But even though a barrier is overcome, of course, project risks are there. Project risks is the deviation of the intended project outcome. But risk is also something to address in overcoming barriers to climate action. If technology is riskier or even perceived as riskier than traditional technologies, that will affect their uptake. If investments into climate actions include or are perceived to include risks, they may not find financing or only find financing at less advantageous conditions. Here we have an insight from the Climate Policy Initiative on Renewable Energy Investments from the year 2013. In 2013, the cost of renewable energy technologies such as wind and solar power was already in decline, and the costs have decreased further ever since. But what is pointed out here is that the risks associated with them were the single most important factor in holding back more investments into these technologies. It further underscores that policymakers can help mitigate risks and risk perception by investors. This is an example of technology risks. What other risks are relevant to our efforts? Let's discuss the different risk categories. Here we find some risk categories. There's country risks. They include the risk that political decisions or macroeconomic developments relating to exchange rates, to currency stability, and the national debt affect the project outcome. There's policy and regulatory risk, and they are another category. Climate projects often rely on favorable government policies and regulations to receive incentives, subsidies, or support. Changes in these policies or regulations can impact project economics and viability. Projects may become less attractive or even financially unfeasible if government support is reduced or withdrawn. Then there's, of course, technology risks, as we mentioned. Many climate projects involve the deployment of innovative and sometimes in the country unproven technologies that are applied for the first time, that are new to the local context or the relevant stakeholders. The perceived risks, especially from financial stakeholders, is that these technologies may face unexpected technical challenges, delays, or even failures, leading to cost overruns and operational disruptions. Operational performance risk. The long-term success of a project in the climate realm depends on their operational efficiency and effectiveness. Technical issues, inadequate maintenance, or underperformance compared to projected outcomes can undermine the financial sustainability of the project. There's climate environmental risk. Many projects in climate change mitigation and adaptation themselves can be exposed to climate-related risks, such as extreme weather events, sea level rise, changing environmental conditions, temperature rise. These risks can damage project infrastructure, disrupt operations, and lead to additional unplanned expenses. The impacts of climate change on climate-relevant infrastructure can be sudden or it can be gradual. Hydropower, for example, in many locations is vulnerable to climate change impact on the water cycle. This is an example of a gradual impact. Another risk category are financial risks. Climate projects often require significant upfront investment. Securing adequate funding and financing can be challenging, and if funding sources dry up or financing terms become unfavorable, projects could face delays or cancellations. Also, complex climate projects can be prone to cost overruns due to unexpected expenses, changes in the project scope, or underestimated initial budgets. These overruns can strain project finances and delay completion. To mitigate all of these risks, a comprehensive risk assessment and management strategies are what is crucial. This involves identifying potential risks, evaluating the potential impact, and developing contingency plans to address them. Diversifying funding sources, using proven technologies, maintaining close alignment with regulations, and considering the long-term resilience of the project can all contribute to minimizing the financial and operational risks associated with climate projects. In our project design, the use of so-called risk matrices help us to map risks. In fact, for many funding opportunities that you might apply for, the inclusion of such a risk matrix is required. Risks of various natures are assessed first for their probability, for the probability of the risk materializing, and then for the impact that they have in the event of materializing. The product of both factors allows us to assess risks in terms of their severity. Risks that have both a high probability of occurring and a high impact should be prioritized when you think about how we're going to mitigate them. Walking through risks one by one and including risk mitigating strategies allows for forward-looking planning and better project design. Let's walk through two examples to illustrate risks. Our first example is an energy project. Let's say an onshore wind power project. When listing risks for the risk matrix, it helps to think through a project as intended purposes and having intended outcomes. It also helps to think through the construction and the operation of these things as an asset. Even without engineering knowledge, it helps to walk through a number of questions on these aspects. When assessing whether our project addresses the defined need, we can browse public policies and plans. Many countries have specific growth targets for wind power or even prioritized regions for the construction of wind power projects. Licenses for the development of wind power projects may be auctioned off by the government or a regulator. Technology risk is a risk that you need to mitigate, of course, in a wind power project. How to reduce the technology risk, and an in-depth feasibility study can produce clear terms and standards for eligible technologies that project developers can oblige by. This solves the question, is it technically doable and does it solve appropriate technology issues? Such a feasibility analysis can also include the potential of our wind power project to integrate with existing systems, especially the power grid. Forecasts on consumption and data on capacity and discharge rate give indication in this regard. The expected output of our wind power project will be its performance in terms of megawatt hours produced by a specified time. The specified time is the end of the construction and ramp-up period. A construction delay is a typical project risk that affects the output and thus the intended outcome of the project. This is something that a risk matrix will certainly include. Project performance is also a product of other factors, some more foreseeable than others. Wind speed, the timing of the scheduled and unscheduled interruption, for example, for maintenance and such. Does it serve the peak performance intended? Does it serve households or consumers? That's a question that we need to think through to look whether there's a risk. Does it comply with existing laws and regulations? Does it have adverse effects on the environment? How to mitigate those? Does it conflict with other goals? Who charges the customer and who pays if they don't, and so on? These and other questions need to be considered. A similar process and logic can be applied to projects in other sectors. For district heating, for instance, project risk can be listed in the risk matrix and assessed in terms of probability, expected impact, and so on, by thinking through uncertainties surrounding any of the following components. The price of the district heating plant, the reconstruction cost at the plant, the rehabilitation cost of distribution networks, the retrofitting cost in housing blocks, who pays for the metering, who charges the customers, how much is the price of heating, who pays if the customers don't, is there a right to shut it off, and so on. What is the price of fuel? All of these are things that you need to consider in our hypothetical district heating project and in others. What's the price of the workforce and what labor laws govern their employment? What's the cost of financing? More on this issue later. Are there any subsidies to benefit of at the local, national level, or any support from bilateral or multilateral financiers or donors? These are things to consider. The important takeaway from what we discussed so far is it's not about the money, it's about the risk. Risk mitigators need to be included in your project design to gain financing. You cannot mitigate risk with higher returns, as some risks are simply unacceptable to the mostly risk-averse financial institutions that provide this finance. Thus, every time, take just about every imaginable risk and mitigate it through. And when looking for risk mitigators, consider wide-ranging options. It helps to take an interdisciplinary approach here. Of course, one option is to include covenants in contracts that result in mitigated risk. The transfer of risk to other parties, for example, is an option, which we're going to discuss later when we discuss financial instruments. There are legal options to mitigate risk. Off-take agreements in project finance, for instance, are quite common in the energy sector and secure against the risk of failing demand or lower than expected price. An off-take agreement is a legally binding contract between the producer of, say, a renewable energy plant and the buyer to purchase and sell portions of the produced good. Typically, it's negotiated well before the construction, and it locks in demand and a price for energy produced in the future. This helps to cover for some of the risks that we discussed. Another option is to seek financial cover. In development cooperation, currency risk is typically something that developing country partners face when borrowing in currencies other than their home currencies. So you borrow in a currency other than what your revenue might be in. Maybe you borrow in euros, maybe you borrow in dollars. And changes in foreign exchange rates can result in a mismatch between revenues denominated in the local currency and interest and principal expenses denominated in another currency. So one option is to seek borrowing in local currency, and that's provided in some cases by multilateral development banks, for instance. Another option is to seek coverage for risks through a guarantee by export credit agencies. Besides currency risk, export credit agencies also cover other political risks such as expropriation, payment moratoriums imposed by governments, or civil unrest. All these are risk mitigators, and they are helpful as some risks are simply beyond the project's control. With your risk assessment and mitigated, with your risks assessed and mitigated, finding financing will be easier. Now let's look into financial risks specifically. In this part of the session, we will discuss financial risk and what instruments we can use to cover for this financial risk. To do this, it will help us to discuss a couple of project finance concepts and terms first. When we refer to bankability of a project, what do we mean? And how does this differ from other terms such as feasibility and viability? Feasible refers to projects that are technically and politically doable, basically disregarding the cost or making assumptions about the cost that justifies undertaking a study of the project's feasibility. Viable are projects that are feasible and that under realistic assumptions produce acceptable returns on investment as determined by the investor. What about bankable? A project is bankable only if such returns are produced with a sufficient level of certainty as perceived by third-party financiers, typically banks, and if they are convinced that the project can service the debt. Here's where risk comes in. Financial risk. Most financial structuring is about comforting the financiers. It's about this latter part, about bankability. And to attain bankability of a project, we need to minimize risk, which is no small feat, as high risk or high risk perception drives the high cost of financing in developing countries. Let's look into this more closely. This chart illuminates how cost of additional risk cover for infrastructure investments in the developing world are composed and why they exceed the cost of the same infrastructure in the developed world. The source of this chart is DB Climate Change Advisors, and of course it differs very much from asset to asset, but I think broadly it reflects the challenge of financial structuring in developing countries. There is technology risk that's prevalent in the event that the technology has no track record. Fair enough. But what about the other risk associated with developing countries that drive the financing cost? High up, political risk must be covered, usually in the form of high interest rate. Currency risk might result in a demand for higher rates, and so on. As you can see, risk cover boosts the cost of capital in developing countries, significantly leading one to conclude that there is a need to mitigate these financial risks, for instance in the form of guarantees, to cut the cost of financing. Among the financial and insurance products we discussed earlier in this training, let's look into more detail into a few that seek to cover for these financial risks. So this is what should help us to keep those financing costs from ballooning. In this table, what you see are a number of financing tools and instruments that range from public sector instruments to source investments, to operational instruments used by the public sector, to private sector financing instruments that are business opportunities in themselves. Let's focus on the ones that are highlighted in red, as these serve to cover for the financial risks that we are discussing. Risk cover instruments and guarantees provided by public sources can mitigate the financial risk of projects significantly. Provision of guarantees reduce the cost of financing. Several instruments provided by either the public or the private sector, most often in the form of insurances against certain events. Governments will typically be providing political or policy guarantees. Government agencies may be insuring such guarantees. There are private sector entities that may be providing technology risk covers. There are guarantees that paid for, like an insurance policy if you take them out. And typical providers of such instruments include export credit agencies, include insurance companies, banks, governments, and sometimes even technology suppliers. So to give an example, OPIC, the United States Overseas Private Investment Corporation, has pioneered a feed-in tariff insurance product that provides policy risk coverage in developing countries. However, these are not available for a domestic investor into, say, renewable energy, unfortunately. Now that we've discussed financial risk and what instruments to use to mitigate project risk, let's clarify one thing. Risk management consists not least in an appropriate understanding of a risk hierarchy, as that entertaining example of the windmill below should show. We have a wind turbine in a perilous location. Of course, you could place it there and try and seek a financial guarantees in case a physical hazard should make this wind turbine ineffective. But you are unlikely to succeed. What could happen? Rather than placing the project in a perilous location, let's seek to avoid the risk like this early. Then as a next step, let's seek to insure our project against them, and then adopt the risk management approach that mitigates the risk further. So risk hierarchy is about avoiding risk at the onset, then ensuring whatever you can't avoid, and then manage and mitigate the remaining risk well. Projects in different sectors have different risk profiles. Normally, pure privatization of existing infrastructure with a known history and position in the market have a more easily predictable risk profile and are therefore easier to finance than greenfield projects. Similarly, for the replication of a pilot project, risks are more predictable and thus easier to mitigate. It may also be easier to attract commercial debt for energy supply projects than for road projects because traffic forecasting is more difficult than predictions on power consumption. Actual risk and perceived risk is far from the same. The larger the gap, the better the chances to offer affordable risk cover products. And we should be mindful that risk cannot always be fully mitigated. So there's a remainder of a risk that we might have to live with and that might be priced into financing costs. So even in the landscape of donor-supported and public-supported instruments, there are gaps. There's a lack of investment guarantees for local investors, while foreign investors in developing countries may have access to guarantees through their export credit agencies back at home. When they invest in a developing country, local investors in developing countries may not have the same benefit. A Danish company interested in undertaking a wind power project in a developing country has the option to seek cover for the regulatory risk from the Danish Export Credit Agency, but a local investor may not have the equivalent, access to risk cover. Public sector breach of contract is a risk that's hard to mitigate. Of course, there are sources to cover for political risk, like the World Bank's Multilateral Investment Guarantee Agency. Their breach of contract coverage offers a shield against losses stemming from a government's breach or repudiation of contract. This could be, for instance, a concession or a power purchase agreement that is broken. And in certain circumstances, such coverage may be extended to the contractual obligation of a state-owned enterprise even, not just the government. But in other cases, it may not. Or the World Bank's Multilateral Investment Guarantee Agency may not be interested. It may be too touchy, too risky for them even. In that case, we cannot mitigate the risk fully. Also, we should state here that for some risk, the cost of covering the risk is too high to make it worthwhile. So this is something to keep in mind. In order to illustrate how risk management works in practice in your effort to gain financing for your project, let's study the Green Climate Fund, or GCF, as an example. It has pretty sophisticated risk management procedures, and therefore it makes for a good example. Like other climate funds, GCF is explicitly willing to accept many kinds of risks, technology risk, political risks, and so on, in order to demonstrate, say, the bankability of an innovative financial mechanism, the viability of new business models, or the feasibility of a solution that should be demonstrated in a certain context. The GCF seeks to de-risk climate investments, that is, to transfer the risk of investments from unwilling investors to GCF, and thereby attracting investors to enable them to undertake investments in the first place. GCF seeks to overcome the barrier of a lack of access to finance by accepting risk. It is capitalized in order to do just that. On the other hand, GCF seeks to minimize the risk in two important aspects. The GCF has high integrity standards and zero tolerance for prohibited practices. So, amongst others, it seeks to reduce reputational risk, ensure the continuity of its operation, and also to safeguard that it is pursuing its mission. Its risk appetite statement of 2017 relays as much. Another aspect is that GCF has a risk management policy and has risk management practices, including at the project level. In order to achieve the fund's impact and promote the often mentioned paradigm shift that it seeks, the fund is willing to accept considerable uncertainties around investment risks in return for impact. But in order to demonstrate what we mentioned, so the bankability of an innovative financial mechanisms or the viability of new business models, the fund is well served to include risk assessment and management practices that ensure the best conditions to achieve the impact. Both in the concept note stage that precedes the actual funding proposals and in the actual funding proposals, applicants are required to discuss risks when they apply to the Green Climate Fund. In the concept note, a brief overview of key financial and operational risks and any mitigation measures identified at this stage will suffice. For the funding proposal, a detailed look at risk per category, the probability and impact, and risk mitigation measures have to be discussed. As you can see, this format consists in the risk matrix we described earlier. In the perspective of the GCF, risk categories vary widely. They can include governance risks of a project, they can include legal risk relating to legal aspects of the project, financial risks such as the change in the asset value or an inability to pay back debt. They can include technical and operational risks such as disruption, as we have experienced during the COVID-19 pandemic, or staff turnover. And of course, reputational risks, the negative perception that will affect GCF and its partners, is a risk category to be considered. When categorizing the probability, that is the likelihood of the occurrence or the risk materializing, GCF uses three categories: a low probability, low likelihood, medium, or high. Similarly, when assessing the impact in the event of the occurrence, the same three categories apply: low, medium, high. In terms of responses, the GCF distinguishes between two types of responses. There are measures of prevention which seek to reduce the probability of the risk, so the likelihood of occurrence, the likelihood of the risk materializing. And then there are those that decrease the severity of impact if the risk materializes. Contingent responses include responses that apply once the risk has materialized. For the risk of construction delay, prevention measures could include a variety of measures to include in the project design. For instance, the project could seek to include time buffers, conduct thorough supply assessment, and so on to reduce the risk of a delay in construction. A contingency response to construction delay would consist in measures to respond to the delay. For instance, calling a guarantee if this has been arranged for, to cover the delay in revenues and thus debt settlement payments. Our advice for the concept note to be submitted to the GCF is to include a compelling narrative on the risk assessment and mitigation. Be sure to include at minimum the following: operational risk, that is the risk of being unable to implement the project as planned, must be discussed. Financial risk consists in the risk of not being able to service the loan or the risk to the business model or case of the project. Mitigation measures: how to counter the risks, avoid or address them if they arise. After implementing the mitigation measures, be clear whether the risk is merely reduced or whether it is fully disappearing. You could, of course, at this stage already include a more detailed risk matrix if you have the relevant knowledge and data, but at this stage it's optional. It will become mandatory for the full funding proposal to discuss probability and impact per risk and mitigators as discussed. And that was it for financial and operational risks. Thank you very much for paying attention, and we hope to see you in the next session.